As the end of the year approaches, we seem to be in the midst of a buy everything rally, potential Santa rally, end of year positive momentum. So in today's video, let's review some of the key events on the calendar this week. Most notably, we'll be looking at the US jobs data and the US dollar as well to see how it's been performing as everything else seems to be rallying. Hello, welcome back to our channel. My name is Daniela. In today's video, as I said, we're going to be focusing on the US dollar and the US jobs data, reviewing as well some things that have happened in the last few days. But of course, before we get into this video, please like, comment, subscribe, and turn on your notifications. So as I was saying, we seem to be in the midst of this positive rally. Everything seems to be pushing higher. Equities are showing immense resilience. In Europe as well, specifically, we're seeing the DAX, the IBEX, pushing to recent highs and really seeing that strong momentum higher. In the US, we've seen major US indices plateau a little bit, the likes of the S&P 500, the NASDAQ, they've been trending sideways. The US Russell, the 2000, though, has been really taking strides of this positive momentum. Smaller cap stocks have been taking advantage of the weakness they have faced earlier in the year, while the major stocks were outperforming. Now, in terms of the calendar this week, as I said, aside from some central bank meetings, we have earlier in this week, we have the RBA and the Bank of Canada. On Friday, we'll see the latest jobs data from the US, which will be the November jobs report. And there is quite a bit of focus on that, most importantly, because we're still seeing some weakness in the US dollar. It has recovered in the last week, especially some of that very negative momentum we saw prior to that. But it's still facing some downward and bearish bias. US yields continue to pull back, real yields, of course, being affected the most. And as I said, we have seen some events. Most notably, last week, we saw the PCE index actually coming in line with expectations, but dropping on the month there. Again, just showing that weakness in the US economy. I mean, we have to point out here that by no means is the US economy showing real signs of weakness. Just look at the GDP revision that we saw last week, up to 5.2% in the third quarter. Elsewhere, Europe, negative growth. UK, stagnation. Smaller economies in Europe, negative growth. So the fact that the US economy has still managed to grow 5.2% in the third quarter, whilst inflation has still been an issue, albeit coming down nicely, does show incredible strength and resilience from the US economy. And of course, that is something that Powell focused on his speech on Friday. And it's quite interesting we see how that speech has been gone, because essentially it just felt like it was Powell trying to convince markets that he still remains hawkish and that he still thinks that it's too soon to even start considering rate cuts. Just look at the market reaction. Gold hitting an all-time high this morning in the Asian session. It has come down since then, but nonetheless, pushing strongly towards that 2,150 mark. US yields coming down, the dollar being weighed on. Markets just don't seem to be believing Powell. And to be honest, all fairness, it's right. The messaging on Friday, even though he wanted to come off as hawkish, it is very much laced with conditional references. If there is further need to rate hikes, we could possibly do so. So even though he's trying to give this view that the FOMC remains hawkish, it's not really being portrayed in markets. It's not really convincing market participants. In fact, it's adding more fuel to the fire, that the fact that he's trying to be so blatantly obvious to convince market is essentially his way of admitting that monetary policy has come as far as it needs to, but he doesn't want to give in too soon to those talks about rate cuts, because that in itself would be loosening monetary conditions in the economy and therefore having the opposite effect of what he wants to achieve. So that messaging continues. We have seen messaging from other Fed members as well. We saw Waller last week also talking about the jobs market, saying that while it is cooling, it still remains tight, and therefore further data needs to be seen before the meeting next week. So as I said, on the calendar this week, the US jobs data for November. In the previous week, we saw it come in at 150,000 added jobs in the month. That was below expectations. This month, expectations are for 175,000. Now, if that were the case, we may see it come below expectations once again. But even if it does come in at 175, it's still below the averages for the data. 3 months average, 200,000 jobs added. 6 months average, 205,000 jobs added. 12-month average, 245,000. So 175 would still be below average. It would still be showing this picture that we're seeing a cool down across various aspects or various measures of the labor market. So, of course, they'll be focused on this data, on the unemployment rate as well. Will it remain unchanged at 3.9%? Remember, it ticked up unexpectedly in October. How are average hourly earnings evolving? We did see again coming down on the monthly reading in the previous month. Is it going to remain there? Have we seen a small uptick on those average hourly earnings? So there is going to be focus on this data and, of course, how the US dollar is trading, how gold is trading by contrast as well, how US yields are evolving. And as I said, most of the focus from last week on that speech from Powell, not quite convincing markets there of his hawkishness and the fact that he still remains pretty hopeful or consistent that there could be potentially another rate hike if the data deems to be so. Of course, the data doesn't seem to be warranting that right now. So bets for the next meeting, which will be next week, pretty much 100% chance that there will be no further rate hikes from the Federal Reserve. The focus at that meeting, of course, will be rate cuts. Is there going to be any mention of them? Or is the FOMC going to continue to show this wait and see higher for longer stance? Prior to the meeting next week, we'll also have a US CPI for November, of course, a key figure as well to monitor. And even though it will be the day before the meeting, it will definitely have its impact in markets, as will the jobs data this Friday. Let's jump onto the chart now to see how some of these key pairs have been trading. Let's kick it off with the dollar index here, the major, just to see how it's been trading. Of course, it's Capital.com via Trading View, as always. As you can see here, last week, recovering some strong momentum here on Thursday, pushing higher, up about 0.6%, and coming from that really strong bearish push that we'd seen in the previous month. Of course, the weaker than expected data in the US has been one of the biggest drivers of the weakness in the US dollar. It's been weighing on US yields and, of course, the dollar as well. So we saw a little bit of a respite here last week. But on Thursday, as you can see, when we saw that speech from Powell, we saw the index here closing pretty much unchanged from the open, coming down from those highs that we'd seen, trying to build that higher high and higher low momentum. Didn't quite manage to close within that headspace. Even though we did see that higher high and low, we've already seen a lower high at the open today on Monday. So suggesting that the sustainability of the recovery here in the US dollar started to falter. We're not really seeing that strong buying momentum coming in, even though we are attempting to push higher within the morning today on Monday. Of course, one of the key pairs for this index is euro dollar. So let's take a look at that. It's been a very interesting pair in recent weeks. Of course, the majority of the momentum coming from the dollar side. Now, as I said last week, we did see that weaker than expected inflation from the Eurozone, not only the Eurozone as a group, but from Germany, France, Spain. Those economies within the group have seen some strong downward revisions in inflation. The Eurozone data also coming in below expectations. So, of course, that adding a little bit there to the pair. We didn't necessarily see the most reaction on the back of that. As I said, mostly focused still on the dollar side of this trade. But that pullback here on Friday intensifying, coming just to rest just above that 200-day simple moving average, as you can see, currently hovering around 108.20. Of course, that reversal lower in the dollar meant that we did see a reversal higher for euro dollar. As you can see here, just coming to end the session, again, similar, unchanged from the open. So far this morning, struggling to see that momentum higher. We've already pulled back in the Asian session, finding a little bit of support just around that 20-day simple moving average at 108.54. Now, in terms of the momentum, we had started to see the pair overextend that rally. The RSI was pushing into overbought territory. similar to what we saw back here in July. It was primed for a pullback. So, of course, the pullback here last week, not necessarily surprising. The RSI continues to remain above the 50 line, that midline. So we still have that bullish bias there in the short term. But it's going to be interesting to see how traders, dollar traders, euro traders come into this pair heading into that jobs data on Friday. We could see a little bit of hedging going into that. So maybe some sideways consolidation. We may see the RSI flatten out a little bit alongside the pair, struggling to find that momentum in the first part of the week where we're potentially struggling for new information. Now, also looking at cable here against the pound, you can see similar momentum there on Thursday, actually managing to push higher here. We've seen some good momentum from the British side of this equation as well. We've seen some strong momentum for the pound elsewhere, not only against the dollar, of course, the weakness in the dollar helping. This rally, again, becoming a little bit of overextended here, as you can see, finding some resistance along that 61.8 Fibonacci, around that 127.20 mark. As you can see here, that is from the drop from the highs in July to the lows back here at the beginning of October. So we seem to be recovering some good ground after that pullback throughout the latter part of the summer. Just stagnating there along that 61.8 Fibonacci. Same thing here, the RSI potentially flattening out a little bit today. The pair has already once again topped that resistance. So again, struggling to find that buying momentum to continue to push higher. As I always say, a rally is most healthy and sustainable when we do have challenges to that rally. And of course, last week was a challenge. Today, it seems like that challenge continues. But if we manage to break above this level, manage to get a close above 127.25, then we could potentially reignite this bullish move higher. That is it for today's analysis on the US job data and some of those key US dollar pairs. Thank you so much for watching, and don't forget to subscribe to our channel.